Welcome back everyone to 7-Minute Options. Today I want to talk a little bit about why it makes sense to sell options. Why you want to be in the option selling business, not necessarily the buying business. All right, and to understand that, let's look at the history of options a little bit, right? So the way options came about is, let's say you have an equity. Let's say you got this ETF here, the Spiders, also known as SPY, the S&P 500. So this is one of the most frequently traded options out there. All right. And let's say you own 100 shares. And if you own 100 shares, then this curve is very simple, right? Today it's 415 bucks. And if it goes higher, the higher it goes, the more money you make. The lower it goes, the more money you lose. And so if you have a lot of these, you might want to ask yourself, well, can I buy some kind of an insurance policy that will protect me in case there's a market crash, right? And so, banks being smart, they came around and they said, okay, I tell you what, I'll sell you insurance. How far do you want to go down this options chain here? And somebody said, well, I tell you what, right now it's $415 a share. Let's say 400, right? If SPY goes below $400, I don't want to lose any more money. So I want to be able to sell it to somebody at $400 a share. Doesn't matter how far it goes down. And so you can see here that you can buy insurance for $400. So somebody comes here and buys it and they pay $401. And now when you look at the curve, right, they are protected, right? Again, the higher the SPY goes, the more money they make. But if SPY starts going down, their losses are capped, right? They will not lose more than, in this case, right, $2,000, right? So their losses are capped. And so, but the other thing is, remember, they have to pay $401. So you can see the break even now has actually gone up a little bit, right? Now SPY has to go up a little bit to cover that $401 cost, right? All right. So if you want to go back now and say, well, okay, I'm buying insurance, but think about insurance, right? People who usually buy insurance, like when you buy insurance for your car, it usually costs you money, right? And so you got the car insurance company who sells you car insurance. They always make money, right? And that's because they say, okay, they ask, well, what is the chance of the SPY dropping below 400? And let's see how much, what are the chances of that? And if that happens, how much that's going to cost us? And we want to sell insurance that, is at a premium to that cost, right? That's how insurance companies make money. And options are no different. And this is borne out by backtest after backtest after backtest that insurance on stocks, aka options, are typically overpriced. That is, if you buy them, you're paying a little bit more than what they're actually worth or how much protection they give you. And I mean, this has been proven by people like Tastyworks and Alpha Option. And I mean, this is how it works. But you can actually prove it yourself fairly easily. So if I take a look at, you can do some back tests on your own. This is getvolatility.com. It's the one I use. Again, I'm not being sponsored by Get Volatility. I'm putting it out there because this is available for free. And so you can do this, right? So let's say I go out there and I sell a 30 days to expiration, 20 delta put, and I just sell it. How often do I sell it? I sell it monthly on the 15th of each month, right? And if I go back years and years, do I make money or do I lose money? And you can see that the expected value is actually surprisingly high, right? $61 on average is what you make. Remember, that is accounting for everything. The losses, the gains, on average, that is a winning formula. So the company that's selling these options out there, the insurance company, is making on average $61 on these options, right? This back test actually went back 6 years, right? From the beginning of 2015 to the end of 2021. And this strategy, you just go out there and sell a put on the 15th of each month, once a month on the SPYs at the 20 delta, boom, look at that. You're making money, right? Now what you see is you see a lot of small gains and then boom, a big loss. A lot of small gains, boom, a big loss. That is the nature of the business when you're selling options. You got a lot of small gains and you got a few big losses. So this strategy looks like this. If I look at the histogram, This is the zero line, right? So if you're to the right of this line, you made some money. And look at every single one of these blue lines is money. Say you made 214 bucks, you made 314 bucks, you made 88 bucks, you made 175 bucks, right? But you have a few losses, right? So on 3 occasions, you lost between 0 and 700. On 1 occasion, we got dinged for 924. And on 1 occasion, we would have been dinged 5,400, right? So you have a lot of small gains and you have a few big losses, right? And overall, on average, this is a winning strategy, right? Look at this. You are winning on 93.5% of the trades. So there's a profit to be taken 93% of the time. You're only losing 6% of the time, but those are big losses. But overall, this is a winning strategy historically, right? And that, again, is just another one of the thousands of back tests out there that show that selling options is where the money is. You actually have an edge in the market. You have a statistical edge. You don't have to guess which way the market's going. You don't have to find the next hidden gem or the next Amazon or the next test. No, you just have to go out there once a month and boom, sell an option. Now, not every option is going to be profitable. So you have to do back tests. You have to look at the market and you have to look at the implied volatility. So we're going to talk about that in the next video. Implied volatility is what I like to put on this chart down here. It's what we call IVR, and that tells you right now how volatile or how risky the market is. And you can see when it's very low, option pricing is not that high. When it's very high, that's when option pricing gets rich. And that's when you collect a lot of premium and carry a lot of risk. All right, that's 7 minutes. See you next time. Thanks. All right, very quickly, just to bring it back to the SPY and the options table. So when we talk about the 20 put, right, back in that previous back test example, what that one is over here. So we're on the put side. There's the delta, $19, $20 put right there. You would sell it. Again, in our example, we have 30 days to expiration. This is 29 days to expiration. Right now, you would collect about $313 for this option. All right, thanks. Bye.